Hello, listeners. Welcome to the Credit Compass, the podcast that helps you navigate the world of European credit. I'm Gordon Kerr, European macro strategist and host. Today, we're diving into the latest developments in Europe's economic landscape. We'll explore the preliminary fourth quarter European GDP results, highlight some of the European Commission's recent Competitiveness Compass report, great name, examine the cost of regulation within the European Union, and cover the topic du jour, tariffs. Let's dig in. Starting with the topic of the day, weekend, year, presidential term, however long you want to take, it is tariffs. What are they really and why do they matter? Tariffs have existed forever and are viewed as protectionist measures to adjust the competitiveness of products and businesses. They are usually used to protect strategically important industries and adjust targeted trade imbalances. Typically, most Western economies have used tariffs on products like steel and aluminum to protect these on national security grounds. However, President Trump appears to view them as a negotiating stick with which to threaten countries to comply with his agenda. On the weekend, the Trump administration announced 25% tariffs on Canadian and Mexican goods, plus 10% on China. As of the recording of this podcast, the 25% tariffs on Mexico and Canada have been delayed for 1 month as the countries negotiate with the U.S. Canada has announced a list of potential retaliatory tariffs, and China has stated that it intends to impose tariffs on U.S. crude and other products, as well as to take the U.S. actions to the World Trade Organization. The implication for countries, if fully implemented, is likely to result in a rise in inflation, a rise in unemployment, and overall be recessionary. The end result really depends on the various responses. Now, looking to the European perspective, tariffs are coming to the continent. US President Trump has already foreshadowed their impending announcement. Although he says the UK needs to be less worried as the US has a beneficial trade position with the country. According to an article in The Economist, the European Commission is prepared for Trump tariffs, but it will likely mean overall the U.S. will be engaged in trade wars on multiple fronts. This is not helpful for a European region that continues to struggle with growth. Further, as already mentioned, tariffs are broadly inflationary, just as most regions have managed to temper inflation to near target levels. Currency moves tend to absorb some of the inflationary pressure, but tariffs are not helpful for growth, interest rates, or international relations, at least the way President Trump is treating them. Inflation ticked back up in January for the EU and remains sticky for the UK as well. We don't think the tariff debate will impact the Bank of England decision this week for a cut, but it could start to impact expectations for future cuts from both central banks. On the growth front, according to the data out last week, Europe's economy has stalled. The latest GDP data confirms what many had feared. The Eurozone saw zero growth in the fourth quarter of 2024 as the region struggles to find momentum. Now, when we look at the full year numbers, the picture is just as underwhelming. The euro area grew by only 0.9% in 2024, hardly anything to write home about. Germany, Europe's largest economy, actually shrank by 0.2% in the fourth quarter and ended 2024 with an overall contraction of 0.2% for the year. This is a major concern because traditionally Germany is the industrial powerhouse of Europe, and it continues to struggle, particularly with its manufacturing sector, which is coincidentally a likely target for President Trump on his European list of tariffs. France also shrank in the fourth quarter, declining 0.1% and only growing at 0.7% for the year. Italy was flat in the fourth quarter and only up 0.5% year over year. But as we have highlighted before, not all countries are struggling. Spain bucked the trend, growing by 0.8% in the fourth quarter and 3.5% for the year, making it one of the few bright spots in the Eurozone out of the data released so far. This suggests that structural factors such as economic diversification, tourism, and domestic investment are playing a crucial role in its economic's resilience. So what's causing this stagnation? A mix of ongoing high energy costs, weak consumer spending, and global geopolitical impacts. Germany, in particular, has been hit hard by the loss of cheap energy imports, while France also faces challenging headwinds for its economy. Furthermore, Both are suffering from political challenges, with Germany hosting an election at the end of the month. To address these economic challenges and the challenges presented by the rapid activity of the US President Donald Trump and his administration, the European Commission has launched an ambitious plan called the Competitiveness Compass, which aims to make Europe a more attractive place for investment, innovation, and business growth. This plan has several key components. First, the EU wants to increase venture capital funding and encourage new startup ecosystems to rival the United States and China. Right now, European firms raise only 5% of global venture capital funds, compared to 52% in the US and 40% in China. The idea is to create a new EU startup and scale-up strategy to make it easier for businesses to grow across borders. Cross-border issues were also highlighted, and the idea is to bring down some of these barriers that have existed and continue to resist removal. Another big focus is energy and industrial competitiveness. With high energy prices making European industries less competitive, the EU is proposing an affordable energy action plan to bring costs down and invest in renewable infrastructure. But here's the challenge. These initiatives require money, and despite its promise, they actually don't cut red tape. Instead, they are more legislation acts that then need to be implemented by country governments. And that brings us to the cost of regulation. A study from Columbia Business School estimates that excessive regulatory red tape reduces GDP by about 0.8% on average across Europe. In countries like France, the cost is even higher at 4% of GDP. That's a huge drag on economic growth, and it's something businesses have been complaining about for years. According to Eurointelligence, the total costs of bureaucracy is 1.6% of GDP in Germany. And if you include the opportunity cost, it amounts to 3.6%, according to the IFO Institute. The IFO also states that 57% of those costs are due to EU legislation. The Commission says that it wants to cut regulatory burdens by at least 25% for all companies and 35% for SMEs. This could save billions in compliance costs and boost economic activity. But the real question is whether governments will follow through and implement these reforms sufficiently at the national level. The Draghi report highlighted this challenge, and the Commission's plan seems to fall somewhat short of requirements to offset and compete with the rapid actions in the US. Most of these red tape cuts stated focus on ESG reporting requirements, not exactly a big step out of the way of growing businesses. Europe needs to act rapidly and help to deploy the large amounts of savings amongst European consumers, but it will likely take considerable time to implement any strategy. One element of hope in this regard is the formation of Draghi's recommended Commissioner for Implementation and Simplification, a sort of European version of the DOGE, the Department of Government Efficiency, in the US. This should help to at least avoid some of the duplication and to help simplify both existing and new regulations. So where does this leave Europe? The latest data suggests that the region is at an economic crossroads. If the competitiveness compass succeeds, we could see higher investment, stronger businesses, and better long-term growth. Further, it demonstrates a proactive approach to enhancing the region's economic resilience and global standing, a first for Europe since it attempted to create a capital markets union ages ago. We are still awaiting the completion and benefits of that one. If the regulatory and fiscal burdens remain high, stagnation could persist, and governments may have to take on more debt to fund these ambitious plans, and the global standing of European businesses will continue to struggle. In any case, nothing is happening fast enough to support growth in the first half of this year. Given valuations are priced for perfection, the past several days have highlighted that it would be worth moving up the quality curve and taking a more defensive positioning. As always, staying informed is key to navigating these complexities. Thank you for joining us on the Credit Compass. If you found today's discussion helpful, don't forget to like, subscribe, and share the podcast with colleagues and friends. And if you have questions or topics you'd like us to cover in future episodes, please drop me a line at any time. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.